Well, we'll ask Shane Oliver now, Chief Economist and Head of Investment Strategy at AMP, what he thinks of this all. He joins us from Sydney. Shane, great to see you as ever. Let's just talk a little bit about 25 basis points is pretty much done, but a lot of people are saying that 50 needs to be done. Would 50 smack of panic more than anything else?
Well, no, it wouldn't. I think that's the argument of many economists, that a move of 50 against a norm of 25 would signal some sort of panic at the Reserve Bank. I don't think that's the case. I think the reality is the Reserve Bank has been wrong for the last 3 months. Banks have hiked up mortgage rates and lending rates independently of the Reserve Bank to get interest rates back to where they were 3 months ago. That's the actual lending rates. I think we need to see at least 50 because we don't know how much the banks are going to cut by. So I think a 50-point move by the Reserve Bank would be common sense, just to make sure we get a decent cut in mortgage rates. And as to the talk about a panic, I think that can be handled by the Reserve Bank saying we just want to see a decent cut in mortgage rates come through, don't expect 50 basis points going forward, with the implication we'll probably revert to 25. So I think that an appropriate wording of the statement can justify quite easily a 50-point move by the Reserve Bank.
So, Shane, if we got, let's say, 25 basis points, isn't your argument that the banks would probably pass through 0.15% instead? So if we got 50, we'd get, what, 0.3% as a cut in mortgage rates?
Yeah, that's right. I think, yeah, if we got 25, they'd pass half of that on, maybe 10 to 15 basis points. That effectively would just take mortgage rates back to where they were before the Australian banks started moving independently back in February. So Australian households net would probably regard that as trivial or a bit of a joke. Alternatively, if we got 50 basis points, the banks would probably cut by, 0.35% or 35 basis points. And so that would unwind the tightening or the rate hike that Australian households have seen so far this year, plus provide a bit more on top of that. And I think that's what's really needed. The economic data as it unfolds in Australia, even today, house prices down again in the March quarter, a survey for April showing further weakness in April, a survey of manufacturing PMI in Australia had a sharp fall in April. Data yesterday, still soft private sector credit, new home sales, down 9%. So the Australian economy is really struggling. Sure, we've got the mining boom coming through, so on average it's not that bad, but it's nowhere near as strong as the Reserve Bank was thinking. There's no inflationary pressure. At this point in time, we'd need much lower interest rates.
Well, of course, and also would a weaker currency help as well, particularly the eastern seaboard of Australia?
A weaker currency certainly would help, and it would obviously unwind some of the weakness you're seeing in manufacturing. But I think that's just wishful thinking. It's interesting, last week when the inflation figures came out, well on the downside, we ended the week with the Aussie dollar around $104.7 US cents. The Aussie dollar actually rose last week and is still above 104 US cents at the moment. So I don't think one can rely on rate cuts from the Reserve Bank to push the Aussie dollar down. Certainly a 25-point cut wouldn't make much difference. It's already factored in. I think the Reserve Bank would have to do a lot more than the market's already thinking to get the Aussie down significantly. Because the reality is, even though the Reserve Bank is cutting interest rates, or about to, the Fed has rates near zero, so the interest rate gap's still going to remain fairly wide, and there's still talk of another round of quantitative easing in the US, which acts as a drag on the US dollar. So I don't think Australia should rely on getting a weaker currency through. I think really we have to do it ourselves by lowering interest rates.
Let's, Shane, just as you mentioned the US there, of course, we get vital data. We, of course, had GDP, which was weaker than anticipated last week. We got that all-important non-farm payrolls report on Friday. What will it tell us?
It will probably tell us that the US labour market is still expanding. I suspect we'll get something around consensus in terms of non-farm payrolls, and I think the consensus is for a gain of about 175,000. So no great disagreement with that. But it's not the 200,000 or 250,000 plus that you really need to get unemployment down at a decent clip. So it'll basically tell us the US economy is sort of motoring along, but at around a 2 to 2.5% pace, rather than what you'd normally get coming in an economy with so much spare capacity. We normally get, say, 3 to 4% growth. So US economy is still motoring along, but perhaps still not strong enough to satisfy Ben Bernanke.
Shane, thank you so much for that. Shane Oliver there joining us from Sydney ahead of that
My pleasure.
all-important RBA decision.